Hi, I'm Cynthia Asen, dealing representative with Integrated Equities. Over the past 30 years, I've helped hundreds of people add real estate to their financial portfolio. Today, I'm introducing a boutique real estate investment and management firm, Revesco Properties Trust. Revesco acquires ownership in open-air shopping centers and mixed-use properties in markets throughout the United States. As an investor, you benefit from deep industry experience and relationships of the team that has led Revesco to incredible success over the past 12 years. Revesco money is right beside you. The principals of Revesco personally invest 10% of any equity placed by investors. It offers a tax-efficient way to invest in U.S. retail real estate alongside a qualified sponsor. Today I'm in conversation with Chris Wood and Scott Lee, founding partners of Revesco. Of note, both Chris and Scott have actively been involved in retail real estate in the U.S. since 1989. Some of their clients include, and you may recognize them, Target, Apple, Winners, HomeSense, Indigo, just to name a few. So without further ado, thanks Scott, thanks Chris for taking the time.
Thanks for having us.
Appreciate the time.
Well, let's talk about the white elephant in the room. Everyone is shopping on Amazon. Online shopping, it's growing exponentially. Who's going to go to these shopping centers? Let's talk about that.
Let me grab that one. Candidly, numbers never lie. So we always look at the numbers. The one great thing that came out of COVID was, even in the height of COVID, only 16.2% of sales in the US were done online. That number today is roughly 14. What does that tell us? Online is finally found its spot next to bricks and mortar retail. Bricks and mortar retail is never going away. 86% of all sales are done in a store. So Amazon, everybody says, yeah, they're gonna kill bricks and mortar. Couldn't be farther from the truth, right? The other thing that happens is online only retailers are now opening bricks and mortar stores. So if you think about Allbirds, you think about Warby Parker, you think about Casper, there's a whole long line of them. They are opening bricks and mortar stores. You think about Amazon. Amazon bought this little thing called Whole Foods. They've been rolling out Amazon Fresh. They've got their own bookstore, convenience store, apparel stores that are opening. Bricks and mortar has never been more alive. And how do we know that? Way more store openings than closings. And in open air retail, the overall vacancy rate in the US is at a historical low of 4.5%. Like, we've never seen that in our 30 plus year career. So Amazon to me is great.
And I think your open air, let's touch on that. There are shopping malls, but you're very focused on the open air. And I understand that because I go to these retail centers and it's actually an experience. So the mix of tenants and mix of services or restaurants is really important to attract that clientele. But maybe you want to talk about why you like open air versus.
Sure. I mean, the enclosed mall world is not something that we invest in, primarily because they are very big ticket items. And we found that anytime you put a roof over something, you've got to heat it, you've got to secure it, you've got to clean it. It becomes very expensive for the tenant. In the United States, I think the enclosed mall world was overbuilt. And as a consequence, the open air shopping center world, where we will tend to focus on where there are groceries and daily needs, and those are where the opportunities lie.
Yeah, and I think, I mean, anyone listening, I'm sure you know that you'd like going to that. We have an example in Vancouver, Park Royal. I mean, they've done a phenomenal job building out that mall. Now it's got residential, but you can drive up to the store. I think that's important too, and you're not in that mall. So awesome. So let's start with, what is the company's overall strategy for acquiring and managing open air retail centers in the US?
Well, we certainly try to acquire the best possible open air shopping centers in growing trade areas, in markets where population is growing, household incomes are growing, people are moving in, and selfishly, it's just great for retail.
Yeah, I mean, our team is headquartered in Denver. So the other factor is we are very active managers, both on the property and asset management side of the business. So we are within a flight of our Denver home office to every asset that we own. so that if a tenant wants to tour, we've had hail events, we've had flooding events, somebody from our team is on the ground next day.
I think the key point is with Revesco is that we have boots on the ground. If there's ever an issue, we're there.
Good, and that's a good point. Now, how does the company identify potential retail centers and assess their viability? What's your process?
Well, it's very long and in depth. It's kind of analogous to a funnel. We look at 1 million deals before we'll actually find one of interest. And when we do, then we'll take a look at the trade area, as Scott was saying. As long as it's growing, you've got good incomes, good education levels, then it becomes interesting. If it's interesting, we'll dig in deeper, and then we'll say, do we like the anchor tenants? Do we like the real estate fundamentals? Access, egress, parking? Do we like the revenue? And do we see the ability to add value?
I think part of Revesco's secret sauce as well is our ability to connect with those anchor tenants and really dive into the performance of some of these centers so that we can essentially reduce risk at the end of the day.
Right, knowing the questions to ask and having those relationships that you've had for a long time. Track record, let's talk about it. You've been in business, you've delivered great results, and obviously you underwrite properly, so your ability to deliver results is great. But let's talk about how do you see sustaining that, and what is your goal when it comes to sustaining long-term growth?
Well, I think a big word around our shop is alignment, right? We want to have alignment both internally with our team as well as our external investors. And we still have the same investors we had from day one, right? And that alignment helps us create value. We want to have aligned long-term capital with long-term assets. The way you create value in these assets is over the long term. You know, you can't just fix an open air retail center and turn it around tomorrow. It's a multi-year process, but over that process, we've been very fortunate, and our track record supports it. We've had a very good success rate. We've candidly never lost money on a deal, and our average return over the 12 years we've been around is in excess of 20%.
Keep in mind too, Revesco's money is right beside the investor's money. And so we're highly focused and aligned with all the investors in looking to provide steady, predictable cash flow with upside and growth.
Exactly. So in terms of debt, I think you'd go fixed, not variable. Like you're mitigating your risk.
Yeah, debt is a big part of our discussions weekly.
Exactly.
With everything that's going on in the market, with interest rates going from essentially 0 to 5%, and mortgage rates getting priced off that, it's affected values. But we've always had a debt strategy. Our CFO is a very, very particular individual around debt. So if you look at the portfolio today, our loan to value is 54%. We have no variable rate debt in the portfolio, and we don't have a mortgage that rolls until 2027. And that's by design. As we grow, we want to ensure that we're very, very focused on our debt strategy, and we ultimately want to end up in a place where we don't have more than 10 to 15% of our debt rolling in any one year.
Exactly. So
Right.
ladder it, make sure you're not exposed. So how do you differentiate yourself from others that do what you do? What would be your secret sauce, as you say?
Yeah, I mean, we talked about our tenant relationships and our background in retail. For better or for worse, we've been in this industry for over 30 years each, and know most of, if not all, the major retailers across North America. We can pick up the phone and get access to all the major players we need to in order to really get the true information in terms of what's happening at these centers. So that's number one. Number two is our team. I mean, it's not just Chris and I. It's a whole team based in Denver that allows us to do what we do and perform for our investors.
Yeah, I mean, Scott's spot on. The only other things that I would add is with that 30 plus years of experience, you start really understanding how to properly merchandise a center, how to restructure lease deals. These are things that not many people can do.
Right.
Right? And it comes from, candidly, working through tough deals, as opposed to things are really easy when the rising tide raises all boats.
Yeah.
We've been through 3 cycles in 30 plus years, and we've figured it out in the toughest of times.
Yeah, and also just finally add that, you know, I think that's probably what distinguishes Revesco as a sponsor versus some others, is essentially we have been around a long time, and we have seen the various cycles and what to do and what not to do through them.
Right. So, I mean, as with all private equity, and I talk to my clients about this often, is that, look, you need to be investing in the general partners or the people that are running the show, because that's where you're putting your faith and your confidence and your trust and your experience, your relationships.
Okay.
That's you're in a business that you know intimately well. So obviously that's very helpful. So I guess projected returns. What are the projected returns? What do you see going forward from today, making acquisitions? What are you penciling in? What is your comfort in terms of returns?
The way we've structured things right now is we make a 6% annual distribution. That comes straight out of cash flow of the operating asset. So our targeted return is 10 to 14%. We always get asked, how do you get there, right? Sort of simple stuff for real estate guys like Scott and I, but first and foremost, you're leasing vacant space, you're restructuring lease deals. Those are both accretive to cash flow and valuation. Where possible, we have a strong team when it comes to development, so we can add development density, just conceptually building a standalone building, taking a single level building and making it 2 or more levels. And then lastly, just like your home, we're paying down the mortgage every month. So our targeted return, once again, 10 to 14%. In our first year, even with all setup costs, we were roughly 10%.
Wow.
So we're feeling really good about our ability to hit those numbers, and historically, as I mentioned earlier, we've done much better than that. So over time, we want to increase the 6 to something higher, and we want to exceed 10 to 14.
Why don't you talk about how you feel about this cycle, what we're seeing, and what's going to happen next?
Yeah, it's a really good thing because we talk about it a lot, right? You see a lot of bad news out there, right? People handing the keys back on assets, interest rates are high, potential recession. You know, for Scott and I, we're excited. Like, we're genuinely excited because we know that we're going to buy high quality assets that have to be sold at 15 to 20% discounts from their valuations as recent as a year ago. Like, we are absolutely excited. What it does take is equity, right? We've gone from a place where money was essentially free to cash is king again. You know, you need cash, you need good relationships with lenders to get debt, and if you've got that, you're gonna carve some of the sharpest deals you possibly can over the next 12 to 24 months.
Yeah, so it's a buying, it's for the right time to buy.
100%.
Because when everyone else is selling, right? Buy low, sell high, not the other way around. Okay, so let's talk about risk management. You mentioned some of it, locking the debt. So tell us more about some of the ways that you mitigate risk from your investments.
Well, certainly from a leasing perspective and an asset management perspective, we're always looking at our tenants and their businesses and making sure that they are performing well, they're healthy, we stay in constant contact with them. We look at our lease expiries very carefully. So what that means is we're being proactive. In several of our centers, for example, we have tenants that may not come up for renewal until 2024, maybe 2025. For us, that's when we start getting busy. That's when we start, talking to the tenants, looking at their situation and seeing whether or not they are in the right spot, in the right size, and how they relate to market rents.
Right.
One of the other things that we always do is we have a metric called WALT, weighted average lease term. So in our portfolio today, our average weighted lease term is a little over 4.2 years. So we've got certainty of cash flow, but we always look at the anchor tenants and where they fit into that WALT. So when we talk about restructuring lease deals, if I can take an anchor tenant in any one of our centers and extend their lease to a new 10-year term, that gives us a lot of comfort and that mitigates a lot of risk. once you've got that anchor tenant locked down, the rest of the leasing program and merchandising mix for that center typically comes together, right? So Walt is super important for us. And it's also worth mentioning that most of our anchor tenants, they're publicly traded companies that make a lot of money.
Right.
And whether it's in a good time or a bad time, I'm never worried about cashing a check from TJ Maxx or Floor & Decor. These are companies with multi-billion-dollar valuations and are publicly traded and very, very financially healthy. So I think those things all mitigate our risk.
So we talked about debt risk, we talked about leasing risk. Finally, is geographic risk. We try to make sure that we are in areas that we talked about before, are growing and are in the right spots, good trade areas. Also, something that we have to now start paying a little more attention to is climate risk. Making sure that we're not, acquiring too many assets in one geographic area that perhaps are subject to flooding or other, climate-related events. So we pay attention to all that.
So is it like Canada and the US? I don't know, because I'm not familiar with the leasing. Is it triple net? Like, does it mean that if those insurance costs rise, if those operation costs rise, it's not the trust that takes the hit, it's the tenant? Obviously, you have to make sure the tenant can afford it, but is that similar in the US?
Absolutely.
Okay.
Absolutely. If you take a look at the portfolio that we have today, like, I can't think of a gross lease that we've got. Everything is triple net.
Right. Which is great. I mean, for my clients in particular, a lot of them are in residential, and that's borne by the landlord. Any increase in operation costs is borne by the landlord, and obviously we're seeing insurance premiums across the board literally skyrocket.
Now, as a quality sponsor, one of the things that we try to do is maintain a close eye on the operating costs of the shopping center, like insurance and what have you, because the higher those costs means the less net rent that we can acquire for the REIT. And so that's very important for us overall as a manager.
Yeah, so I mean, I think we've covered enough to, it's worth the look. I mean, most of our clients have invested in residential, commercial. I like the triple net. I like that aspect of it, so that you're not bearing the cost of increased operating costs. Obviously, it does impact your tenants. And then working with quality tenants, and just your experience, your relationships, really make me feel very comfortable about my money's in good hands. So thanks, guys. Good conversation.
Thanks very much.